Peter Drager, Head of Development for Hybrid and Off-Grid at Juwi Renewable Energies.
Thank you, Brendan, for the introduction. And yes, it is quite a changing market and a transitioning market at the moment, and definitely exciting for Juwi. But first of all, thanks for PayDirt for putting this event on. I think much like what the mining industry is going through at the moment with the challenges due to COVID, PayDirt's definitely have their challenges as well. So appreciate that, and thank you to everyone here listening today, the die-hard ADU supporters in the last session. Let me move to my next slide. First up, I'd just like to touch on the mining industry at the moment and where we've come in the last few years. So obviously went through the global pandemic, and it's been amazing to see how robust the mining industry is, bouncing back or continuing through the pandemic with some growth in some areas, and even in 2021 having the significant growth that it has had. It has really been a backbone of some economies, and definitely in developing countries, it has been something that has kept those places going. So the mining industry is definitely important to the world, particularly in developing places. The demand for commodities and the corresponding commodity prices have no doubt played a role in that strong mining industry. And one thing that has been a part of that is the particular transition to the low carbon economy that we're seeing at the moment, particularly with the deployment of renewable energy generation and battery storage technologies. One key part of that that I'd like to focus on is copper and the use of copper in low carbon technologies. Particularly at the moment, we have seen a 40% increase or revenue increase between 2020 and 2021, and one of the key contributors to that has been the implementation of renewable energies and the copper therein. Before I jump onto where I see copper going, or where the market sees copper going in the future, I'd like to just touch on where we see growth in the coming years through a range of different energy technologies. And I think, as you can see here, there's a number of mines that will contribute to this renewable energy or low carbon economy, ranging from, if I talk about key minerals, copper in electrical cabling and electrical components in some of these technologies, iron ore and steel in a lot of the structures, even rare earth materials going into permanent magnets, as an example, in wind turbines. But across the board, the transition to a low carbon economy requires a substantial input from mines, and therein lies a substantial opportunity for miners. And this trend will continue for many years to come. Particularly for copper, as Carl Simic mentioned yesterday, it's a key transition material. And if we look at the expected capacity, annual installation capacity in the coming years, between 2020, I should move on, sorry, through from 2020 to 2030 and through to 2050, we're seeing a substantial increase in the annual requirement or annual demand for copper. So if we look at between 2020 and 2030, we're expecting a doubling of annual requirement. What that looks like in tonnage for particular technologies, solar PV and wind, if we add them together, at the moment there's a 1.1 million tonne per annum requirement, which is expected to increase to 2.2 million tonnes by 2030 and continue to increase through to 2050. And if we look at particular technologies, solar PV, if we put that in perspective, 1 megawatt of solar PV requires 5 tonnes of copper in that installation. Similar with wind, about 4 tonnes. If we look at the Sukari solar project, which we're building in Egypt at the moment, that's a 36 megawatt solar farm, will require in the range of 180 tonnes of of copper, which is a key component. So that in itself, copper is one mineral that's used. There's many other minerals that are used in clean technologies, and they will continue on in a similar trajectory in the coming years. So there is definitely opportunity. From an ESG perspective, if we look at mining operations and how ESG is viewed in the market at the moment, it's been something that has had a lot of focus, particularly in the last 2 years, and a lot of policies have been solidified in boardrooms around the world, and a lot of organisations have put in place robust goals in order to sort of improve their operations in line with international guidelines. And that not only improves the benefit to the communities and the environment and the world around them, but it's also an opportunity to unlock long-term growth for these companies. One interesting metric that was reported by PwC in their Mine 2021 report was that companies with higher ESG ratings had an average shareholder return of 34% over the last 3 years, which is 10% higher than the general market. So there is tangible value in implementing ESG policies for your mining operations. Another key benefit to implementing ESG targets is product and operations differentiation. So selling product into the market, what we're seeing now, on top of the investor sentiments is is purchases of product are looking at de-risked product through their own ESG goals, but also from a general view perspective, they would rather purchase product from companies with positive ESG policies. Further to that, improved access to capital is another topic that is seen with these ESG policies. As an example, Newmont recently announced a $3 billion sustainability-aligned revolving credit facility, which is key to their operations. So the mining industry is in transition at the moment in that regard, but with change does come opportunity. Particularly, I'll focus on the carbon emission side of ESG for now, which is a key part to those policies. And if we look at some of the majors across the industry and their targets in the coming years, particularly BHP, Rio, Newmont, Goldfields have all targeted a net zero emissions by 2050. Some majors are also have more ambitious targets with Anglo and Sibanye with net zero by 2040. And an interesting case is De Beers having a net zero target by 2030, which is from what I understand, the reasons for that is targeting the millennials, I suppose, with more green diamonds, put it like that. But on top of their ESG targets, they have alternative reasons for having a more ambitious goal. So what are the key drivers behind companies implementing emission reduction targets? Can be anything from possible operational disruptions due to changing weather patterns, increased operating costs due to putting in place resilience measures, or even local carbon taxes. And one recent item has been possible green deals and carbon border taxes, particularly in Europe, where there's talk of if product is being pushed into Europe, there's taxes if the carbon emissions associated with that product do not meet certain standards. On top of that, as I mentioned before, increased relevance to investors and product acceptability in global markets. I'm looking at one particular company in Rio Tinto. I think they've, after the Juwi Gorge destruction in the last couple of years, have definitely pushed hard on their ESG responsibilities. And again, I mentioned before, they have a net zero emissions target by 2050. And looking at their sustainability fact book, which is available online, might be a little bit difficult for you to see, but if we break down their Scope 1 and Scope 2 emissions by source, 35% of their emissions come from purchased power, 8% from generated power, so on-site generation, 14% from process heat, 23% from anodes and reductants, 16% from mobile diesel, and 4% of other, which may be released gases from their operations or something similar. As part of the decarbonisation approach, Rio are implementing a staged approach which looks at available technologies in the market now, the carbon intensities of their different processes, and also the cost of reducing those emissions in relation to their operational cost. But what's clear in all this, and looking at Rio as well as other operations, is that renewable energy is, let's say, the low-hanging fruit for reducing emissions in their operations. So if we look at and these two graphs are from the Rio Tinto sustainability report, but basically their strategy is between 2020 and 2035 as a push to reduce one of their largest emission sources, which is electricity generation, and that's between 2020 and 2035. Further to that, process heat is the next one down the list, which they're looking to change between 2025 and 2050. Mobile diesel, which with the coming on of fleet electrification will in the end increase their electricity consumption on site, but provides the opportunity to cover that mobile fleet emissions with renewable electricity. And one interesting quote from that Rio Tinto report was, "Innovation is the key to decarbonisation, and we expect the challenge will deliver exciting new concepts that could drive huge long-term benefits for our industry and environment." So that's something we all look up to, the top-tier miners, but it is good to see that Rio Tinto has that approach in this regard. If we look at a particular type of mine in terms of their operational emissions, it changes from site to site. So between gold, copper, iron ore, bauxite, as an example, there's vastly different emissions per tonne of product. For example, gold ore at 3.5 grams per tonne is 200 kilowatt hours per tonne. Copper ore, 80 kilowatt hours per tonne. Iron ore, 40 kilowatt hours per tonne. Bauxite is less than 20 kilowatt hours per tonne. So in terms of pushing ore through processes and how to reduce the emissions surrounding that, each mine has a different approach, and there's no one-size-fits-all approach to reducing emissions on these sites. But for most operations, the primary sources are electrical generation, diesel for mobile plant, and process heat, and then process release gas. If we look at particularly a gold mining operation, I've put some numbers up on there. Depending on electrical consumption in particular, depending on the site, whether it's an off-grid site running on heavy fuel oil or an on-grid mine, in South Africa as an example, the emissions from a gold mine can vary between 55 and 90%. So there's significant opportunity for renewables in that regard. And I am a little bit behind, so I better crack on. Some key things that are a focus for mining companies in their transition to renewable energy is ESG, regulatory requirements, the cost of renewable energy and battery storage, and lastly, reliability and cost of conventional generation. So Juwi, who are we? We're a developer, EPC contractor and O&M contractor for large-scale renewable energy systems, particularly focusing on hybrid power systems for mining operations. And here's a list of our current mining clients that we have at the moment. And what we have found is it's a significant opportunity in this space for this transition to clean technologies, not only for mines to utilise the higher demand of materials for new energy, but also for reducing or improving their ESG with on-site renewables. Our clients, we probably have we are the leading supplier of hybrid systems for mines in the world, with a number of projects throughout Australia and Africa. Small list there. In particular, we have the Centamin project at the Sukari gold mine, which consists of a 36 megawatt solar farm and battery storage connected with the HFO power plant, which is really a jewel in the crown for us in Africa and a key project with many to come. Pan-African Resources, which is a grid-connected project in South Africa. Again, it's one of the first of its kind, behind-the-meter solar farm connected to a gold retreatment plant, which we're seeing as quite a significant market with the recent changes in the South African regulatory division. In terms of procurement, there's a number of different ways you can procure electricity from grid power, which currently South Africa, as an example, is running 10% on renewable energy, so that's a possibility, self-financed or through corporate PPAs. Final takeaway, not one of our projects that we've done has increased the cost of production at the mines. It's always provided a lower cost generation to these sites. So what we can say is these projects can improve your ESG profile while not increasing your cost of production at your site. So, thank you very much.